Live from Singapore, this is Insight with me, Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. A resurgent US dollar is posing more trouble for Asian currencies, China's central bank being forced to further boost its support for the yuan. Speculation that the Fed will cut rates later than sooner, also deepening the sell-off in treasuries and stocks. Also ahead, NVIDIA founder Jensen Huang expresses confidence in Samsung, giving its stock a boost despite disappointing earnings as it plays catch-up in AI. Plus, Singapore and Malaysia have just formalized a special economic zone linking their borders. We'll look at which companies could be the beneficiaries the most. It is about the Fed higher for longer. It is about the mighty dollar putting a lot of pressure onto Asian currencies, particularly the Chinese yuan, and the PBOC not taking that for granted continues to provide support. If you take a look at today's fix, that fix is more than 1,500 pips higher than market anticipated. In terms of the yuan trading at 734.52, still underperforming the dollar right now. The Japanese yen, another currency that we're tracking right now, pretty flat versus the USD, but 158 is the level we're looking at. Of course, we've heard traders saying again and again, 160 is what is expected. We're also tracking treasuries. We saw how treasuries fell across the curve overnight, pretty steady in Asia right now. Still, it is about a higher yield environment. People are now talking about 10-year yield getting to 5. We're not that far away from that, but that is the expectation. 10-year yields for 67.68. So higher yield, strong dollar, putting a lot of pressure on risk assets. Let's get more on markets with Vanessa, co-founder and CIO of VS Partners in Hong Kong. Vanessa, good to have you with us. I mean, there's a lot of trepidation, nerves in the market about that strong dollar and, of course, that reversal in expectations when it comes to Fed rate cuts this year.
Well, thanks for having me. First of all, back in December when Chairman Powell made the hawkish dovish announcement, actually the U.S. fundamental is going very well. From the fundamental perspective, it withstands 3 years of rate cycle, and there was no fundamental reason to cut. And the inflation, our view has always been that is going to be more persistent than it sounds like. But the final cut and the pause actually give the political aware Fed with the incoming Trump administration the optionality to act either way. And our base case is still that with the Bresson policy in sight, that the CPI in the U.S. will moderately trending towards the Fed target, so that the cut will be modest, but it could also be no cuts, and we are positioning for that no cut conservative scenario, unless the Treasury market suffers a disorderly sell-off, then the Fed had that optionality to act quickly to cut faster and provide the liquidity to stabilize the market functioning. So watching the Treasury market is really key.
And we saw that sell-off in treasuries overnight. Some say it is a signal that the equity market is just too exuberant, bearing in mind that, we saw the rally in equities partly because there were expectations of Fed rate cuts. And now that's been pulled back, dialed back in a significant way.
Well, you're right that the market, the equity market is really frothy. The valuation by all the measurements historically are at all the risky levels, but it doesn't mean that it is crazy. And the market functioning is still orderly. Frankly, a healthy correction 10%-ish, or even can go to 15%, is constructive, and it's much needed, and it's better to happen earlier rather than later. Otherwise, something else is going to break. In the last administration, outgoing administration, Janet Yellen has maneuvered a non-yield yield curve control by issuing treasuries through bills, through short end. And that is going to pose a very big challenge to the incoming Treasury Secretary to, number one, still fund the government obligations, but also keep the bond market functioning. And for that, that is a very significant risk, not only to the asset class correlations in the U.S., but globally. So we're watching that very carefully. But the fundamental of the U.S. market is healthy, and if the correction indeed happened to the level that I mentioned, we are also watching the depth and the breadth of the market and the mid-market value, for example, quality domestic stocks, then it would be a good time to get back in.
Vanessa, we know that Trump has given the impetus, the catalyst for markets to go higher, but Trump is also causing a lot of chaos and causing a lot of nerves in the markets, geopolitics in particular. Take a listen to what he said. We've been talking about that Trump chaos. Take a listen to his recent comments.
Can you assure the world that as you try to get control of these areas, you are not going to use military or economic coercion?
No. I can't assure you. You're talking about Panama and Greenland. No, I can't assure you on either of those two. But I can say this. We need them for economic security.
How do you play the market given the Trump risk as well?
Well, Trump has a tactic to sound very hawkish. And I think this administration, if we look at his picks for critical positions, there is a mixture of the very capable, very experienced people in respective seats. And I think he might surprise on the upside that with the hawkish cabinet that he puts together, that actually provides him the plausible deniability, if you will, for lack of better words, to calibrate the policies if needed to be to collaborate with the rest of the world for his MAGA agenda. What's key to watch out is the 3-3-3 economic agenda by the incoming nominated Treasury Secretary, being that very pro-business 3% GDP target. And 3 million barrels of oil and 3% of budget deficit. If the U.S. indeed is able to achieve that, and continue to be the largest growth engine, demand engine of the world economy, not only that the U.S. asset market will be constructive, but also that it benefits the rest of the world.
So fair to say when it comes to 2025, keep investing in the U.S. S&P will continue to grind higher, but there'll be more volatility. Expect vol going forward.
Yeah, have that stomach for the volatility in the U.S. and keep investing. And I think the U.S. is still going to be one of the well-performing. I couldn't say whether it's the best or not, but it will be one of the well-performing markets by the year end.
So surging yields, we've been talking about surging yields in the U.S. On the opposite side is declining yields in China. Now, more and more people are coming out to say that in terms of CGG yields, it will get even closer to zero, not just close to 1, but closer to 0. How are you reading that?
Well, it's predictable when Chinese economy is going through a balance sheet deflationary period and a clearance of excessive capacities. The interest rate side has to will behave like that. But I think the market, what I wanted to say is perhaps too much simplified. The stimulus packages started in late September by just putting a numerical number as to how many $1 trillion of the liquidity being pumped into the market without looking at the layers of the structure and its targeted objective. I think the first layer of the objective is to stem any illiquidity, insolvency, failure of large debt repayment events to avoid a systemic risk. I think that is by and large achieved. And the second layer is to provide the most bottom layer of social security coverage for the general mass for the social stability reasons. And the thirdly is to provide liquidity to revitalize the local government functionalities and give them, allow them to refinance such that they become a spender and a creator of a demand and jobs. And after all of these three is being put into place, then let the economy itself slowly heal. So I think give it some patience, and we perhaps will see in 6 to 12 months of readable, measurable improvements. That's my prediction.
Are you then saying that concerns, the alarm of a deflationary spiral in China's economy is pretty much misplaced? I mean, if you take a look at the stunning gap between, the yields in the U.S. and China, I mean, we're talking about a gap of 300 basis points. Surely that must be saying something.
Yes. You're right, but, the PBOC has to navigate a very challenging, impossible triangle, and letting the currency depreciate in a wider band actually helps to absorb that deflationary downward pressure and helps the economy in terms of the export. By the way, you just very mentioned Japanese yen, and one of the consensus mistake in 2024 was that most of the commentators thought the Japanese yen was so undervalued, therefore it was bound to revalue, and that after the summer pop, that didn't happen. I think a weak Japanese yen plus a strong dollar as a combination is a very potent duo to curb Chinese export as a part of the geoeconomics. I wouldn't say geopolitics, but geoeconomics play. So PBOC has to navigate these internal and external factors, and seeing as long as the funding market, the bond market domestically is functioning orderly, I think the policymakers will have that tolerance. But there are green shoots in the Chinese economy's stabilization. I would not go as optimistic as to say that the deflationary pressure has ended. I think it's still there. But in most of the major cities, if we look at the real estate market, it began to reverse the Q-on-Q decline, and has shown stabilizing signs in terms of volume and price. And if this momentum continues, which requires more fiscal policy support, then we will see improvement in the fundamental. So very selective cyclical recoveries in China. For example, in the overall weak consumption picture, airlines, travel, and some of the please myself type of consumptions has recovered, but that's not enough to magnitude compared to the sheer size of the entire economy.
When you take a look at 2025, what is your overriding conviction call?
Okay. Number one, U.S., as I mentioned, is going to be a most strategic market to be in. Number two, China could surprise the world on the upside. Number three, although India recently has experienced economic trending down, cyclical downward adjustments, and also the capital markets reflected that, but India is also a strategic investment. It has, at the fundamental level, a lot of the things going at the opposite barbell way than China. So India needs to produce and add more credit and expand the capex and expand capacity for the consumers, and China is at the opposite. Theoretically, if Indian consumers come to China to consume the goods, then we solve a lot of the world's problems. So we are very closely watching India, where the domestic savings will become a big source of liquidity to the domestic capital markets, which last year took over many other Asia exchanges to become the largest IPO market. So I think India, we will wait for an entry point as well. These are the three convictions this year.
Great calls and great insights. Vanessa Xu, VS Partners Hong Kong, thank you. Now, just ahead on Insight, Samsung's quarterly profit misses estimates, but shares jump on supportive comments from NVIDIA boss Jensen Huang. We'll dig into the earnings and the outlook next. Keep it here with us. This is Bloomberg. Welcome back to Insight. Samsung has reported lower than expected profits in the latest quarter as it tries to claw back market share in the AI chip and smartphone markets. But NVIDIA CEO Jensen Huang giving a vote of confidence that Samsung will be able to sort out its challenges producing new high bandwidth memory chips. Let's get more with tech editor Mayumi Negeshi. Mayumi, I mean, some relief from Jensen Huang, but it doesn't take away from the fact that Samsung is undergoing one of the toughest moments in its history.
That's correct. Samsung is playing in a rare position of playing catch-up to far smaller rival SK Hynix in the area of AI memory. It's the one area in the memory market that is growing by leaps and bounds, and Samsung just completely missed much of that growth. It's really the revenge of success because Samsung is so big and is such the undisputed memory leader. It's exposed to all kinds of conventional memory, and so missed out on this one segment, and it's now trying to regain its footing. It's a huge ship that needs to be turned around but it's trying to deploy more of its focus. It's deploying its R&D, it's deploying its front-end manufacturing capacity, and those costs weighed on its quarterly earnings in the December quarter, and that's why it missed estimates this time around. NVIDIA CEO Jensen Huang gave some relief. He did confirm that Samsung has to go back to the drawing board, that it's actually has to redesign much of its high bandwidth memory chip so that it can be twinned with NVIDIA's AI chip accelerators. But he expressed that they're moving very fast, and we're talking about like huge resources at Samsung that if they can deploy those resources effectively, it may help close the gap with SK Hynix.
That is one issue, Mayumi. The other issues as well has to do with the missteps, to do with AI, as well as smartphones. I'm just wondering, when you take all those issues into consideration, when do you think we can expect a meaningful turnaround, recovery for Samsung?
Well, that's the billions dollars question. SK Hynix has a huge lead on this, on the very high-end, high-bandwidth memory. But NVIDIA, for its part, doesn't want to be so wholly reliant on just one or two suppliers, on just SK Hynix or Micron. That exposes it to less bargaining power when it comes to pricing. So for NVIDIA's part, it wants to encourage Samsung to catch up. So there are forces that are sort of kind of helping to push Samsung forward, but Samsung is trying to effect this turnaround around at precisely the time that its conventional chips the demand is is weakening there. So it's a bit of a, some analysts say, oh, you'll see some meaningful clients coming on board in the first or second quarter, but the jury is out there.
That's right. It's still a challenging environment for Samsung. Bloomberg's tech editor Mayumi Nageshi in Tokyo, of course, talking about Samsung, which is the most valuable company in South Korea. Meantime, NVIDIA shares fell after a wide-ranging product presentation by CEO Jensen Huang failed to win over investors. Huang also spoke to Bloomberg Technology about the company's plans under incoming President Donald Trump, as well as the impact of AI on the gaming industry.
AI is going to reinvigorate the video game industry. On the one hand, for developers, it's going to reduce the cost of creating the content. On the other hand, all of the characters that are in the games are going to be smart characters in the future. So every time you interact with them, they're going to be interacting with you in a much more intelligent way. And so the games are going to be more interesting. The characters are going to be more interesting. The content development cost is going to decline, and that's going to be really great for the industry. And so I think that the future is really bright for video games and these virtual worlds, and artificial intelligence is going to really reinvigorate it.
Project Digits. May I pick it up?
Yeah.
$3,000 Project
Yeah.
Digits.
Yeah.
A supercomputer you can put
sitting
on
right
your
next.
desk.
Exactly. Could you imagine you're just sitting there just like that? You're working on your PC.
Well, I can't imagine. Why would I need one of these? Probably not me. But how big is the addressable market for this? What is the addressable market?
There are 30 million software developers. There are probably something along the lines of 10 million designers around the world. Probably another 20 million creative artists. Hard to say exactly how many students. I'm going to guess probably a couple of 100 million students around the world. Everybody's going to have to. Everybody's going to have to. Well, they can afford computers, and so if they can afford computers and they would like to have a companion that helps them do AI, this is the way to do it.
Can I just clarify something on it? I think you said on stage. Mac OS, Linux, and Windows, but the communication said just Linux.
No. Whatever computer you use, you're literally enjoying how it's going to be used. It's sitting right there, and you just connect to it wirelessly like it's your personal cloud.
I promised the audience I'd clarify that because they're excited. We're running short on time. President-elect Trump has been speaking during the course of the conversation. How imperative is it that you go to Mar-a-Lago and meet with him if NVIDIA is America's leading AI company? And will you?
I'd be delighted to go see him.
Have you been invited?
Not yet, but I would be delighted to go see him and congratulate him and do everything we can to help this administration succeed.
A lot of what you outlined on stage last night in the realm of physical AI, I saw Xpeng, for example, in the autonomous driving context. That's happening in China. Like, they are doing a lot on robotics. So I'm going to ask you about tariffs. It's likely this coming administration will be as restrictive on technology export, and tariffs will be a function. How have you prepared for that, Jensen?
Whatever the administration ultimately decides, we'll give them as much insight as we can from our perspective. And I'm sure that the administration will make the right moves. That's in the best interest of our country.
NVIDIA CEO Jensen Huang speaking with Bloomberg Technology co-anchor Ed Ludlow. Now, still to come on Inside, Malaysia unveils tech incentives for the new Johor Singapore Special Economic Zone. We'll assess the market impact for Southeast Asia next with Macquarie Capital. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. In this week's ASEAN Ahead, we're shining the spotlight on Singapore and Malaysia. The neighbours have joined hands to create a special economic zone to attract investment. Huang has been following developments. I mean, it's not without naysayers, right? I mean, huge ambitions. We're talking about a creation, at least they say, 100,000 jobs, adding $26 billion to the Malaysian economy. But those are ambitions.
Yeah. Pretty lofty at this point, but there is a lot of optimism surrounding this, challenges as you alluded to. But I think it's worth taking a step back as we look at this. This is after a number of delays before we actually see them finalizing this agreement to establish a special economic zone between Singapore and the southern Malaysian state of Johor. And, you know, as you say, the aim is 50 projects within the first 5 years, 100 within the first 10. And, you know, they're really thinking about the creation of jobs, skilled jobs that they want to see. And amid all this, they're trying to kind of entice firms via incentives. This includes special tax rates. We've seen this a Malaysia announcement of 5% for the corporate tax and 15% for employees that are eligible within the zone just today. And both sides have kind of lauded this, right? Both of the prime ministers have kind of signaled this is a win-win, a way for firms to capitalize on the strengths of both Singapore and Malaysia. For Singapore, it's about the R&D prowess. For Malaysia, it's the availability of cheaper manpower, land as well. As you say, when it comes to the challenges, key among them, I think, is the movement smoothly that we want to see of goods and people. And as you know, jams are still a big issue at this border crossing between Singapore and Johor. It is among the world's busiest. Hundreds of thousands cross on a daily basis. And the upcoming rail link, the hopes are that will help to alleviate some of the congestion. But beyond that, there are also some potential challenges. When you look at how some of the firms that were surveyed prior to the signing, they flagged concerns surrounding red tape and talent shortages. And then analysts have also pointed out that when it comes to the streamlining of tax investment policies, it's not yet clear the extent in which they've been streamlined in a way that will actually draw in fresh investment. So a lot of optimism surrounding this, but challenges, as you say.
When it comes to sectors, I mean, we talk about how the real estate sector would be one to watch. It would benefit. But key to all of this is actually data centers. I mean, and when you talk about data centers, we know about how they consume a lot of energy. So, how is this all going to play out?
Yeah, data centers, I think, have been really interesting. As you know, they've really been the Johor state, this darling for data center the industry as a whole. And we've seen it booming in the past couple of years. You talk to any of the data center players, they'll tell you that they've been drawn in by favorable government policies, the availability of land, of energy, as you alluded to. And it's in such a way that even the tech giants are plowing investments into the Johor state, right, to the tune of billions in the past year alone. I spoke to Princeton Digital CEO. This is a data center player that's had a presence in the state of Johor from years back. And, the CEO flagged that what we're seeing in the state is really fundamental change, something that we haven't witnessed in past technological cycles. Have a listen.
In the past, you would have data centers being built for local markets, for local banks or local manufacturing companies, but the tech companies who are buying capacity from us in these data centers are serving AI from Johor to the global market. That's never happened before. So markets like Johor now are on the global footprint for AI. Think about this, a market like Johor, if you have a factory, you're producing manufacturing products for the world. So you're a factory for the world. What data center, AI data center in Johor is the data center for the world. So it's an AI factory for the world.
Johor, the AI factory of the world house. That's really quite something.
That's right. I mean, who would have thought? Avril, stick around. We're going to discuss the longer-term goals of the deal and which stocks stand to benefit. Our next guest thinks Malaysian companies, including some with data center operations, will be among the winners. Let's bring in Jayden Vantarakis, head of ASEAN Research at Macquarie Capital. Good to have you with us.
Thanks for having me, Haslinda.
There will be winners, data centers among them. But, is it going to be a game changer, this economic zone?
I think it's aspirational. I think it's Singapore and Malaysia saying, hey, we're open for business. We want investment. The timing is also interesting as you've got the US presidential change and Malaysia's assuming, the ASEAN chairmanship this year. So I think it's an aspirational sort of creation that they're doing.
What do you see among the stock beneficiaries? I mean, I think you believe that it's going to be more beneficial for Malaysia stocks.
Yeah, I think at the start, that's probably the case. So I'd highlight the energy plays. So Tenaga, YTL Power, which has data centers and water as well. And then there are AI plays as well. So there's Natgate, which is also a stock which we like.
So what's the outlook? How do you play it? I mean, some people say that, you'll see the benefits many years down the road. It's going to be too early to be playing into these companies right now, no?
Yeah, I think, but the investment's already happening, as was highlighted before. So data centers are already taking off. I'd say that more the long term would be around property, construction, and services like banking.
What would investors need to see in order for there to unlock that longer term value in it, not just to be a pure play for property and energy names?
I think the FDI numbers are going to be key. So we've seen ASEAN attract record amounts of FDI. So as a bloc, it was 230 billion in 2023. Last year was strong as well. So I think investors are going to judge it by the strength of the FDI that continues to flow in.
And all this is also, we're focusing on the Malaysia side, but what about for Singapore? I mean, do you see benefits for the stocks here beyond the banking names that are going to facilitate loans, etc., at a time when Singapore is really trying to reinvigorate its stock markets?
Yeah, I think it's probably a bit too early to say. I think we'll have to wait and see which kind of companies set up and how they can be supported from Singapore. But I think the governments are clear to say that it should benefit both sides. It's not a win-lose situation.
It's not a win-lose situation, but there are also risks. You take a look at Trump, for instance. A lot of the Chinese companies, the Chinese AI companies, chip companies, are making their way to Malaysia, including in Johor. You got to wonder, at some point, Trump's going to say, you know what? This ain't happening. The risk is there, and Malaysia could pay the price for it.
Yeah, I think that is a risk and something that investors are increasingly watching. But we have to see what actions he takes, right? There's still a lot of speculation at this point.
Fair to say, though, as it stands now, ASEAN will continue to benefit from China +1, China +2. Under Trump point 2, the region will continue to benefit. No doubt there'll be volatility, but it will continue to benefit. Is there a fair assumption?
Yeah, that's our assumption as well. So we think that the links between China, especially, and ASEAN will get stronger. So I think this is partly what this project is looking to solve for. These markets will become more integrated.
What are the economies that you think would, benefit the most? Because I think you have a pecking order of, the kind of investment benefits and flow, something that we already saw underway after the first trade war, in a way.
Yeah, that's true. So when we look at stock selection, we think about all kinds of factors. So this is obviously one. The other thing that investors look for would be reforms. They look for, obviously, growth. And then we also think about valuations, right? So our framework is suggesting to us that it's actually worthwhile revisiting Indonesia and Philippines, which are two markets that actually have very little direct exposure to US trade. And their markets have been sold down quite aggressively on the US dollar strength we've seen in the fourth quarter.
What about Vietnam? I mean, we've seen how the supply chain adjustment in the first trade war benefited its economy. Why is that kind of not part of your picks?
Yeah, so to be clear, we do ASEAN 5, so because it's not part of the EM universe just yet. But if you look at the trade accounts with US and China, they're obviously a bit higher exposed to US trade. So one of the reasons for looking at Indonesia and Philippines is that the gross trade with the United States is only 3 to 5% of GDP. For the other markets, it's in the teens and even higher for Vietnam.
So in a way, it is buffeted, but it is not buffeted when it comes to, a strong dollar environment. You take a look at how emerging market currencies have done, including those in Southeast Asia. They've been hammered. Rupiah is one to watch. I mean, Bank Indonesia has said that it wants to stabilize the currency, but it takes a lot of effort to do that.
That's true. So I would say that a lot of those impacts are already in. So if you look at the stock market, both those markets are trading on 10 times earnings. If you look at markets like Malaysia, Thailand, we're on 14 times. So there's a very clear valuation difference that we're looking for. On the currency, I'd say that Bank Indonesia has been very proactive at stabilizing the rupiah, and that's had impacts on domestic liquidity. But our view is that a lot of that's in the price, and so that's why we're very keen to revisit these stocks.
No, but it's interesting because EMs have always started the year, with a positive expectation that they will outperform DMs, for the first time in 7 years, 8 years, whatever the case may be. But it's disappointed time and time again. Will it be different this time around? Bearing in mind that a lot of the markets in Southeast Asia are EMs.
That's true. So if we're wrong, then the rally in Singapore will continue. So Singapore, I should say that Singapore was one of our top picks in 2024. And the market's done really, really well. So we're looking for what could change going forward. But yeah, there are clearly risks. I would acknowledge that. And there are ways that you can hedge if you're looking at Southeast Asia. Singapore would be the clear one. But our view is looking forward. I mean, there's an adjustment period. And these two stock markets have a lot of potential.
What about the extent in which China might be exporting deflation to the Southeast Asian markets? I mean, there's been readjustment, but it's still a really important trading partner.
The biggest trading partner for almost all of the countries here.
Absolutely. Yeah, so I think in some ways this would be helpful for monetary policy in Southeast Asia. I mean, inflation has already been coming down and normalizing. This may actually make it easier for the central banks in this part of the world. And as you highlighted before, Bank Indonesia has been quite keen to focus on currency stability. This would help them a little bit on inflation if that came through.
What about the government's approach to things? How closely do you think foreign firms might be looking at that when assessing Indonesia? I mean, we've seen how they've had a bit of a hardball approach to attracting manufacturing, boosting it locally. iPhone 16 sales have been banned. How closely do you think foreign firms are looking at that?
I think local content regulations have been in place for a long time. So I think a lot of foreign FDI players are well adept at dealing with that. I would say that 2024 was very much a transition year. You had the elections early in the year. The government was only inaugurated in October. They haven't really got to work yet. So I think from a policy standpoint, it will be interesting to see what they do this year. What reforms can they make?
Not just policy, but geopolitics. We talk about Trump, but it's also within the region. If you take a look at the leadership in this part of the world, a new president in Indonesia, a new prime minister in Thailand, and Singapore has a new prime minister too. Their relationships with each other have not been tested. How are you assessing the kind of risk we might see in this part of the world?
Yeah, I think there hasn't been too much issue within ASEAN. I think that the countries have actually got together fairly well. And this Johor-Singapore Special Economic Zone is actually evidence of that in a way. I think navigating the relationship with US and China is going to be the more challenging part, I suspect. And the region is obviously, very carefully neutral geopolitically, wants to do business with both sides.
Until Trump says you got to choose sides. And that has been his stance. You're either with us or against us.
Yeah, that's true. That's the challenge they're going to have to navigate for this year, isn't it?
When you look at, the leanings between the US and China and the picking of sides, the Philippines does have territorial disputes among other countries in the region with China in the South China Sea. But among that also, when you look at the Philippines, there are also domestic feuds between the president, the vice president. Do you think these issues are going to kind of distract from the growth agenda?
So from our perspective, we continue to hear from Philippine businesses that they're happy with the environment. They are investing. They've seen a big improvement. When this new government came in, the term that they used with us was it's night and day, versus dealing with previous governments. So I think we're at the point where we have midterms this year. We still have a couple of years to go for the Marcos administration.
What's the biggest risk for the Philippines right now?
I think, as you identified earlier, if we have a lot of strength in the US dollar, and that just creates tougher liquidity for the market.
Is that the same risk for the rest of the region?
Not necessarily. I mean, for Singapore, they may benefit from that situation, right? You'll see more flows into Singapore. Malaysia and Thailand are somewhere in the middle.
And we know that in times of falling growth, especially when China is in focus, ASEAN nations have strengthened their trade ties with each other. Is that a trend that you're anticipating? And what kind of dynamics are you looking at?
Yeah, I think absolutely the bloc wants to trade more with each other. You're seeing, intra-regional trade continuing to increase. You're seeing investment flows also amongst the markets. So yeah, absolutely, I think that will be a trend that we should see.
ASEAN versus Europe versus the US versus Africa. I mean, can it stand out in 2025?
We think so. Yeah, we think so. I mean, the countries are very different, obviously. They have different risks and opportunities. But look, it's a big magnet for FDI. You've got good GDP growth. We've got 4.8% expected total growth in the region in 2025. We've got good earnings growth as well, 10% across our stocks. So I think it's actually a fairly positive setup for ASEAN.
600, 700 million population. There must be some opportunities there. Jayden, Vantarakis of Macquarie and our very own, of course, Huang. That's Macquarie Capital, by the way. We'll have more on Southeast Asia on Thursday as we come to you live from the Malaysia Economic Forum in Kuala Lumpur. We'll have exclusive interviews with Malaysia's economy and finance ministers, as well as Maybank's group CEO. We'll also discuss rising trade tensions with the Henrik Foundation. Keep it here with us. This is Bloomberg. Hyundai Motor CEO says the carmaker is not concerned with how it ranks against competitors, but it is focused on providing customers with the best product. Jose Muñoz told us exclusively about the company's China strategy and his response to the potential merger between Honda and Nissan.
Basically, for us, being number 3, being number 4, being number 2 is not an objective per se. Our key objective is to provide to our customers with the best product, the best technology, which is safe, the best customer experience. The industry today is more competitive than it's been in the past. Already a few years back, there were a lot of talks and a lot of commentary about consolidation as one potential solution to maintain profitable operations. And if you look at the number of technologies that we have today and compared to 5 years ago, you have EV, and you have much more hybrid, you have plug-in hybrids, you have EREV, you have hydrogen. Well, it is really difficult for a single OEM to be able to invest everywhere. So I think we need to be smart in where we invest our money, but at the same time, you cannot lose the opportunity to get access to the best available and future technology by just doing the things by yourself. So I think the concept of the ecosystem and the partnerships we've utilized in addition to the internal development of our own capabilities and technologies, I think we believe that this is the winning proposition, despite the fact that we are the 3rd largest OEM.
What's your strategy for the China market? Because the legacy overseas car makers are struggling, whether it's GM or others, they're losing money after seeing China as the cash cow. It's changed dynamic dramatically. You have a partnership with BAIC Motor. I understand you're going to inject some $1.1 billion into the China JV. Is this money well spent in a market that is losing market share? All the players are losing market share, the foreign car makers.
We have also been impacted very severely by the situation in the Chinese market. And at the moment, we are trying to readjust our position in the market so we can make it a business unit which is profitable, which is worthwhile having. But let me tell you that being in China, it's also a very good way to experience and to appreciate how to improve and also being humble, looking at how competitors are operating in the market to do a better job, right? So, and then to me, the fact that we are one of the OEMs who have decided to stay the course and invest and grow with our partner, which is a great partner, Beijing Auto, we have a very great relationship with. I think it shows our commitment to our customers in China and also in other markets.
But can you leverage it as an export base at a time of threatened and realized tariffs?
I think so, provided we get the right scale to be competitive. It could be for certain markets, but we also have to improve in the domestic market by having the right products that the Chinese consumers like by having the right positioning, the right distribution, and definitely the competitiveness in terms of price that the Chinese consumer is looking at.
How can you compete against a company like BYD, which is vertically integrated? It, I think, makes its own batteries, about 80% of its own batteries. It has the scale. I mean, a lot of these car makers are not profitable, and that's a political issue as well. It's causing political waves abroad. But how do you compete on price and scale in a market that is dominated by the local players?
Well, we are competing de facto. One thing is to compete, it depends on the market positioning. One thing is to compete in China itself, where at the moment the local Chinese are doing a better job than basically anybody else. In other markets...
Unfairly, though?
Nobody really knows, but we do our best within the rules always. But I would say in other markets like Europe, well, we have them as a competitor, and we do better than them. You go, for example, Brazil, Latin American markets. We just finished the year, and we became number 4 when the Chinese have sold more cars in Brazil than ever in the history. So we are de facto competing with them, and that they are not shortcuts, they are not tricks that you can apply. So you need to be very consistent in terms of having the right economies of scale, having a good quality production capabilities at good cost.
Let's talk about the local situation here right now. Obviously, there's some political unrest here in South Korea with President Yoon under fire. He's been impeached. There's a lot of political uncertainty right now in the presidential office. How is that potentially going to impact consumer sentiment? And as well, it's hit the yuan quite a bit.
First of all, well, I'm not in the politics in any market, and also not in Korea. We're watching carefully, obviously, and then we're focusing on our business where we have not seen any impact so far. We continue to focus on delivering the customer promise, and then hopefully the situation will be clear very soon. But meanwhile, we focus in every single market, doing our very best for our consumers.
And that was Hyundai Motor CEO Jose Muñoz speaking to our very own Chief North Asia correspondent, Stephen Angle. In the markets, it is about the Fed dialing back expectations when it comes to the markets in terms of when it might cut again. Some say it won't happen till July next year. It's also about the mighty dollar. That mighty dollar putting a lot of pressure on Asian currencies, including on the yen and the yuan. And we know the PBOC stepped in today, fixing the currency at about 1,500 pips above what was expected by the market. That strong fix suggesting it is not willing to let, massive moves in the Chinese yuan. And speaking of the Chinese yuan, let's talk about the Chinese economy. Of course, we have stocks under pressure in China, down about 1.5% for the CSI 300 index. And that's because of disappointment of stimulus talks. Of course, we heard in the past hour or so how China is trying to boost its economy, but that is not enough, not up to what markets were expecting. That is it for Inside Horizons. Middle East and Africa is next. Keep it here with us. This is Bloomberg.